7:25 a.m. Pacific Standard Time. Today's date, 11/18/2012. Happy Thanksgiving to our users around the world and in the U.S. What we're taking a look at is the Nasdaq 100 Volatility Index. It's a fear indicator. Now, that's related to this Nasdaq 100 right here and the Nasdaq Composite, both. One of the things that we are very observant is how this bottom end and this range is getting put in. What it really means is that when this breaks higher, markets go up. And when this breaks higher, markets go down. When they go down, markets go up. Now let's say that when I'm breaking higher on this breakout, these indexes will sell down. The problem that we see is that there is a lack of fear, even though that things don't look good. And yes, the markets had a 10% correction territory. But we noticed that this VXN, unlike the VIX, has been consolidating down here. And that this fear indicator is not like it has been all of the other prior years. In 2008, we hit a peak right here. When it hit that peak up there, the markets put their bottoms in 2009. When that went straight all the way down, then markets were rallying higher. Then we got a big fear spike in 2010 area, and markets were putting their bottoms in over here. And when that went straight down, markets rallied straight up. Then we got into 2011 volatility, where we had spikes up here, but then they reversed and markets were doing well. Then in 2011, we had the major correction last year, November, December, with all the austerity. And when this broke out higher, markets were selling down to their all-time lows in the Nasdaq 100 and the Nasdaq Composite. 2012, however, when we take a look at this, we take a look at where there is very little fear. Still, it's at very complacent levels. It's not at blowout tops. The last area in the middle of calendar 2012, we had a great reversal from the bull run high, and we came all the way down. When this peaked, we put in the bottom in June of 2012, then we came all the way down. So when this was falling in value, markets were rallying to all-time highs. Now, when we measure volatility, we can clearly see from 14 to almost 22 here is where part of the correction, which is in 10% correction on the actual indexes. Nasdaq 100 has a 10% correction, Nasdaq Comp. And we can see here short term, when that's breaking higher, markets are in correction. Then we came all the way back down and markets rallied back up to resistance. We put the bottom base in and then we went straight up. This is part of the selling that's happened since the election right in here. Now we are building above the daily simple moving averages. If we continue to sell up and there's no fiscal cliff, that means that this thing has potential to break out higher. Once this does start to break higher, you would want to be short the indexes. You would want to be short individual names that would fall with the broader market. We are putting a consolidation here in the Nasdaq 100 Volatility Index. And it's a great gauge. It's not as accurate as one would think in prior years, meaning that it's been skewed. But the thing about it is, here is the base. Here is the lower support level. So we have 1, 2, 3 support levels here. Support 1, support 2, and we're sitting right here. This is going to be support 3. So you could say support 1, 2, and 3 just backwards. The thing about it is, if we break higher, markets will continue to sell off. It's very important to monitor these things, because if the fear indicators break higher, then the bear funds like the SQQ, and there are a few other bear funds that would be breaking higher. So we're going to be very mindful through the Thanksgiving holiday is if markets rally, this is going to have to come back down. And once they get down here in these lows are still complacent, meaning that there isn't a whole lot of players in the market, so therefore we have to take that into consideration. But for the people that are involved in the high-frequency trading algorithmic programs, they're the ones that skew these indicators. But nonetheless, if we break higher, then we're going to go lower. And the thing about it is sometimes these things can consolidate in their ranges in market volatility up and down within the indexes before either they break down or they break out. It doesn't look good because you see, as we can consolidate here and we continue to move up higher, then we're going to continue that road of selling down in this Nasdaq 100 and the Nasdaq Composite, and it's related to the Nasdaq 100 and the Nasdaq Composite. Nasdaq 100 Market Volatility Index is setting up a base. The key moving averages to look at in this incident is going to be the 50-day, the 200-day simple moving averages. Right now they're below it. However, it's when they get above those key daily moving averages and we break higher, markets will continue to sell.